Welcome to another episode of the Cross Country Super Podcast. And of course, I'm joined as usual by Jemma Sanderson over in the lovely West. You're not in Perth today, but it's great. It's great to see you. And that, again, we're crossing the nation to bring you this podcast.
Yeah, it's nice to be able to do these sorts of things, online. I guess we have to thank COVID for that, and the fact that I'm not in Perth but in Busselton today, and we can still make it happen. So it's great. Thanks for having me, Darin.
That's great. Give your hometown a plug. That's good. I think that's important.
The event capital of WA, apparently. So.
Oh, is it? Okay. Well, there you
Yeah.
go. I've learnt something today then.
There you go.
We're going to talk about some specific issues about contributions today, Jemma, which is another exciting topic I'm sure we can both get stuck into. So, contributions are a funny thing. You'd think that just putting money into super is a fairly basic concept, simple concept, but it's not as simple as it appears on face value, obviously. And there are all sorts of rules and regulations that you have to take into account, which can be obviously very beneficial if you do a deep dive into some of the strategies that can help you get even more money into super than you probably thought was possible if you were just an average consumer out there. So let's start by having a look at the bring forward provision. So that's the non-concessional contribution bring forward, the ability to bring forward up to 3 years worth of contributions and put them into your super fund in one particular year. So what are the rules around that? And it's been made a little bit more complicated now, I know.
Well, unpacking what are the rules around it, there's an hour's worth of presentation. And it's interesting and I recall back when the bring forward rules were first introduced, back in the day, 2007, when all that sort of came through, and we had the caps back then, and then we obviously pulled them back a little bit, and you have to look at the total super balance and how that all works. So it's really interesting when you unpack that and apply all the rules across there. So basically, if you're eligible to, you can use your current year's cap, which is sitting at $110,000 for a single year. And if you make a contribution that's over that, so $110,001, then you may trigger a bring forward period. And that bring forward period could be 2 years or 3 years. And and that depends on what your total super balance was at the prior 30 June. So if it's a 3-year period, you can use the current year's cap and the next 2 years worth of cap. So if I was to make a $110,001 contribution today, and my total super balance at 30 June 2023 was under $1.48 million, then I will trigger a 3-year contribution cap. And so I can then top up my 110,001 over the period of time from 1 July 2023 to 30 June 2026. So that's sort of what that looks like. Now, there's other little quirky things that are all involved in that, but effectively, I've got $330,000 available, so the current year and the next 2, to make over that period of time. So that's very, very high level what that looks like. Now, let's say, so that's if my total super was less than 1.48 million at 30 June 2023. If my total super balance was over 1.48 but less than $1.59 million, then I don't have a 3-year limit available. I've only got a 2-year limit and a $220,000 amount available over that 2-year period of time. So in that situation, if I put in 330, but I've only got 220 available, obviously I'm going to have an excess, which I then need to deal with, and no doubt we'll discuss that in more detail later on. So we need to be really careful that we're not inadvertently triggering bring forward periods, but we're aware of what that bring forward period and cap actually is, because if our cap is only 220 and we put in 330, then we're going to have an excess that needs to be dealt with. So that's the first thing. But back to how those caps work. So say I've got my 2-year cap there. The other consideration is if I'm between 1.59 and 1.7, I can only use my single year cap. So I've only got 110,000 available. So if I put in $110,001 today and I've only got 110,000 available, then I'm going to have a $1 excess. So maybe, like, who cares from that perspective with the $1? But it's only just over the single year cap. If you go over the single year cap, then that's when you can trigger a bring forward. So that can be really, really important, that people don't inadvertently trigger a bring forward period by making more than the single year cap. Because what often happens is, and particularly at this time of the year, so, you know, we're in January, and I know that we're only 6 months, just over 6 months into the financial year, but this is where people start thinking about, okay, am I making big contributions to super? Do I put in 330 now? And that will cover me for the current year and the next 2, or do I put in 110 now, wait till after 30 June, and then do my 330, which might actually then be 360 with indexation. So we're getting to that point. So that whole contribution strategy sounds great, but if I put in $110,001, then I will trigger my bring forward in the current year, which means that I'm then limited how much I could put into the fund in July. And what can trigger that bring forward is then what is a contribution? So there's a tax ruling on that, TR 2010-1, which the tax office is in the process of updating based on the non-arm's length income, non-arm's length expense sort of guidance that they've got out there. So certain things can be contributions that people don't necessarily think about. But one of the areas that does inadvertently trigger bring forward periods is, which comes through that, is where an individual meets an expense on behalf of the fund and doesn't get reimbursed for that. Generally, that's classified as a contribution. The other is where an individual makes an excess concessional contribution, and they, because it's so minor, say it's $10 over because of their super guarantee or their salary sacrifice, they're like, oh, it's $10, who cares? And they just let it, you know, work its way through the system. That $10 gets treated as a non-concessional contribution, and that may inadvertently trigger a bring forward period. So we just really need to be careful from that perspective. Now, just quickly back to my thresholds. So if you have $1.9 million sitting in there, and actually I've just given you all the wrong thresholds. I've given you the thresholds from a prior year, not the current year. So I'll go back and tell you that in a moment. So if you've got one, so instead of 1.48 that I mentioned, I'm thinking historically, it's 1.68, and between 1.68 and 1.79, and then 1.79 to 1.9, that is where you've got your 110. If you've got more than 1.9 million sitting in your total super balance at 30 June 2023, then you actually have no contribution cap available. Now, from that perspective, if you did make a contribution, it would be excessive. There's a distinction there between people may exceed their contribution cap, and so then you have to deal with it under the tax rules because it's a tax concept. You haven't breached the super rules by making a contribution that might be over your contribution cap. So there's no CIS issue with going over your cap. It's a tax issue. So the CIS side of things is whether or not a fund can accept a contribution rather than, which has different rules attached to it, as opposed to the tax side of things, which is what are your contribution limits? If you go over that limit, it then needs to be considered and looking at how do you deal with it? Because there's 2 ways to deal with an excess contribution. The first way is that you can just leave the excess in the fund, and then it will be subject to, and they're talking non-concessional contributions here, it'll be subject to excess non-concessional contributions tax, which is a mouthful. That is at the highest marginal tax rate plus Medicare, so that's a 47% tax rate. Now, if you have an excess of $10, you might not care, but if you've got an excess of $110,000, you're going to care, and so you will certainly not go down that path. Now, in saying that, that is not the default position that is taken. The default position is that that amount gets released from superannuation. So if I'm in excess of my cap by $110,000, the tax office will do its data matching, send out a notice and say, "Dear Jemma, you've gone over your cap. It was $110,000 over. This is how it all works. You've got the option of taking out that excess plus an amount of 85% of what's called associated earnings also gets released from super. And I'll tell you about how that works in a moment. So 110,000 plus 85% of my associated earnings gets released from my super fund to the tax office. The tax office deducts any extra tax on that, and then that gets hits my personal income tax account, and I get the money out. It gets refunded to me from that perspective. Now, there's a disincentive for making extra or going over your contribution limit, and that's this associated earnings component. So the way that that works is that if I make a contribution today, then and it's excessive, so I've got $110,000 excess, I'll use my example, then I end up with the situation that that excess is subject to associated earnings over the period of time from 1 July of the year of the excess. So even though I haven't made the contribution till January, I get attributed with earnings on that excess from 1 July 2023 until the tax office issues the notice of assessment. And that generally happens, that could be a year from now, let's say January 2025. So that's subject to when my super fund might lodge its annual return and me lodging my own personal return, because that all needs to be data matched up. Because what happens is the associated earnings, so let's say it's from 1 July 23 to the end of January 25 is the period of time that it accrues. So that's 18 months. It accrues at the general interest charge rate, which is currently sitting at over 11%. So it's a pretty hefty rate that would apply. So say I've got my 110,000 at 11% over an 18-month period of time. So let's call it $20,000 worth of income or associated earnings on that. I'm personally taxed on that $20,000 at my marginal tax rate, but I get a 15% tax offset on the basis that that earnings has been earned in the fund and the fund has paid 15% tax on that. So when the amount gets released from the fund of the 110,000 plus 85% of the associated earnings, that 85% is also on the basis that the fund has already paid 15% tax on it, on that amount. So that gets released to the tax office. They deduct that extra tax, and then I get the amount subsequent to that. So it's not really straightforward at all whatsoever. And but that's the default position, which is good, because it used to be a year ago that if you inadvertently triggered a bring forward, there was a 95% tax liability on a contribution. And because this refunding mechanism wasn't in place. And so it's not ideal to have an excess contribution, because you've got to go through, and I call it the faffing around factor. There's a lot of faffing around with this. Plus, if I put in a contribution today, it might be over a year until that amount gets released back to me through that tax office mechanism. So it's not a matter of going, oh, whoops, I put in 110. Oh, I'll just take it out and reverse that transaction, because you then don't get any recognition of the money coming out to offset the amount that has to come out when the tax office tells you to. Plus, I'm too young to access my super. So if I put in 110 and then go whoopsie and whip it back out again, I've then breached the payment standards. So there's a lot of issues that people may not be alive to make sure that they don't inadvertently end up with some SIS breaches subsequent to that. So sorry, there's a bit of a rant there, Darin.
No, as I said at the start, it's not necessarily a straightforward area of superannuation, even though on the surface it would appear it would be just getting money into your super, is a fairly fundamental concept of the whole retirement savings scheme. Just on the total super balance bandwidth you were talking about with the bring forward provisions, they're a movable feast, aren't they? So just because you've triggered it in one year doesn't necessarily mean it, whatever you're entitled to at that point in time, you will be entitled to. So you can just assume that that's it going forward. So for what I'm trying to get at is that if you go $1 over, and at that point in time you're allowed, or it's, you qualify to trigger a bring forward of $330,000. You can't just assume that at a later date it will still be $330,000, can you? You have to constantly monitor what your total super balance is in order to fit in with the rules.
Absolutely. And I guess because it's a moving feast, that can be the excuse for my error earlier on getting the thresholds incorrect. But that's definitely something that we need to be mindful of. So if you triggered your bring forward in the current year because your total super balance was less than 1.68 million at 30 June 2023, so by putting in $110,001, so okay, you've got then $330,000 available in the 23-24 year, 24-25, 25-26. And so you leave your 110, that's all you contribute this year because that's all you might have available outside super. Then next year you have you sell an asset and you've got some money sitting there. So you've still got an amount left of your 330, but your ability to top up your 330 is then dependent on what your total super balance was, say at 30 June 2024. Now, from that perspective, you only have to be less than the upper threshold in order to top up that amount. So we don't have to overlay how those thresholds work with what's left over. It's just, are you less than the upper threshold? And, so if you've got, if the total super balance remains at the upper threshold remains at $1.9 million at 30 June 20 for the 24-25 year, you just need to have 1,899,999, and then you could top up your $219,999 next financial year of your 330. So there's that situation. The other thing is, if say you at 30 June 2023, you've got you're over the $1.9 million threshold, so you can't make a contribution in the current year. Then at 30 June 2024, one of your investments goes down in value or you take out a withdrawal, then you might fall below how those thresholds work, which means in the following year, you then have the opportunity to perhaps top up. So it is very much a moving feast. We encounter quite a few times where people assume that they have a 330 cap, but it was really 220. And then they think, oh, I've got to wait the 3 years. Well, actually, it was only 2 years. So then you've got the opportunity to, start maybe another 3-year period, depending on what your total super balance is. So it's definitely not as straightforward at all. And then with the thresholds all being indexed on an ongoing basis, that adds a layer of complexity to things as well. And it's this time of the year that people might be looking at, okay, do I make a contribution to super or not? And unhelpfully, the answer to that is it depends. And so at this time of the year, we might be looking at the scenarios of, okay, well, Jemma, don't contribute 330 this year, even though your total super balance might enable you to do that. Let's put in 110 this year. And on the basis that maybe the thresholds are going to be indexed for 1 July 2024, or we want to put in, if it's still 330, we want to do the 330 in July, then let's do 110 now, 330 then. So within a 6-month period of time, we've been able to get $440,000 as contributions into the fund for me, or $460,000 if the thresholds get indexed over that period of time. Now, obviously, my ability to do the 330 or 360 in the 24-25 year is then dependent on my total super balance at 30 June 24 and what those total super balance thresholds might be. because if the contribution cap is indexed, but the transfer balance cap isn't, then they will shift. But if the both get indexed, again, they'll shift forward. But if the transfer balance cap isn't indexed, it'll actually shift backwards. It's very counterintuitive. So what happens in the lead up to 30 June is, okay, well, Jemma was under her lower threshold at 30 June 2023, but her investments have gone amazingly this year. And so if we don't top her up this year by using their 330, then actually next year she's ineligible to make a contribution because she's already over at 1.9. So there's that ongoing review of things that needs to happen from that perspective.
Yeah, that's really interesting that you mentioned all of that. I know that you mentioned a lot of information there, but one of the takeaways, I think, is how the different thresholds interact with each other. And boy, that is pretty complicated for the average punter to try and understand, because, indexation of one thing, non-indexation of another, that is very, very difficult to navigate, I've got to say. And certainly one of the areas of the system I think probably needs addressing, not that it will be addressed soon, but it does make it pretty complicated. Makes it complicated enough for us. And, we're looking at this stuff all the time versus somebody who's not. One of the other things I think you've really highlighted there too is that with the use of the bring forward provisions, it sounds like it really should be a strategic decision, because there are so many moving parts to it. It's not, it's not necessarily something where, oh, Jemma, you've told me I've gone $10 over, or okay, well, let's do the bring forward because it wasn't my intention to do the bring forward in the first place. And then, of course, comes a lot of other complexity of it, of how you're going to execute that and what you want to do. So it would appear to me anyway that this really should be, obviously you can't guarantee these things because of errors that are made, but it should really be a specific strategic decision made to take advantage of these rules.
Oh, absolutely. And I think that, again, you don't want to inadvertently trigger a bring forward. And it does happen more often than you'd think. People, again, make excess contributions, or they've been paying for an insurance only. They've been making regular monthly payments towards a life insurance policy that they didn't appreciate was held in a super fund, as like an insurance only super fund. So those would generally get treated as non-concessional contributions. So again, they end up going over the cap. The other thing that we also encounter is that the bring forward cap you have available is a function of your total super balance, not and your contribution, but not your contribution. So if someone made a contribution of 220,000 and thought, oh, well, I've only got a 2-year bring forward period, so that'll reset soon anyway. If they were under the lower threshold, the 1.68 million, by putting in 220, they've triggered a 3-year period. You only get the 2-year period if you're between 1.68 and 1.79. So it's, again, understanding how all of that works to make sure that we're not missing out on opportunities to make contributions, but also we don't end up inadvertently triggering various items. And particularly with the change that came about 1 July 22 with the extension of the work test changes and the extension of the bring forward being available, that was huge and fantastic to enable people to make bring forward contributions all the way up to the 28 days after the end of the month of their 75th birthday, where they were under 74 at the start of the financial year. So I'm talking there, if someone is 74 in June, turns 75 in June, then they need to make a contribution of the bring forward in that year. They can't wait until the 28th of July to actually make a bring forward because they weren't under 75. Anyway, see, complicated, right? So it's, but that has really given rise to, some some complexities and issues. However, it's really opened up the strategic planning for a lot of people who were between 67 and 75, where you had to meet a work test to make a non-concessional contribution before, and you was only eligible to do the 110 regardless of what your total super balance was. Whereas now it's available with no work test all the way up to basically age 75. But that's brought with it a whole raft of other considerations, because given that that's no longer, the work test is no longer in the SIS Act as a requirement for a fund to make sure that, Jemma's met the work test, therefore we can accept the contribution. So the work test is now in the Tax Act, and that then determines the ability for someone to claim a tax deduction for a contribution if they're over 67. So they've got to meet that work test, 40 hours of gainful employment in a consecutive 30-day period. If they don't meet that requirement in that financial year, their contribution that they've made that they might want to claim a tax deduction for and be a concessional contribution is actually then a non-concessional contribution. So you can see there that they might inadvertently trigger a bring forward period, and then that means that they might not be able to implement other contribution strategies that they wanted to do in the lead up to 75. So there's always there's strategic opportunities, but you have to be mindful of some of the issues and make sure you're ticking all the boxes as that progresses through.
Yeah, it seems to be the way it goes. I'm not sure why, as far as the work test goes, the government, they got something against people under the star sign of Gemini or Cancer or some Cancer, because they seem to be the ones who are inadvertently penalized as far as that 28-day period goes. You're just unlucky, aren't you, if you're born in June?
Yeah,
Just
that's
a bit
right.
of bad luck, or,
Yeah.
or certainly mid-June anyway. It's just,
Well, you just need to be
just
on
bad
top of
luck.
it, I think, is yeah. But again, like, it's complicated, and we're in it all day, and so we understand it a lot better and can, process it in our brains. But yeah, when this new sort of stuff comes up, and you spoke about the indexation, and these are two thresholds that are indexed, the transfer balance cap, which then ends up throwing out, the standard transfer balance cap then determines that upper threshold, and then the other two thresholds fall down from that depending on what the contribution limit is. So the transfer balance cap is indexed at a different rate than the contributions. So we've already got a difference there. And
That's
then
brilliant.
you've got, yeah, I know. And then you've got other caps like the carry forward concessional cap total super balance threshold of $500,000 that isn't indexed. So it's just the way that that indexation works. It's either at CPI or average weekly ordinary times earnings, and I always get them mixed up which one's what. But anyway, we're expecting to know what the position will be in mid to late February. The expectation is that the contribution cap will be indexed, but whether the transfer balance cap gets indexed is still a bit hit and miss. So then we could have that, like I said, that quirky scenario of where the contribution cap is indexed, but the total super balance thresholds go down because the transfer balance cap might remain at 1.9 million, but then the other thresholds are based on, the 1.9 less the, it'll be $120,000 will be the new non-concessional single year cap. So then the upper limit goes from 1.9, then it'll be 1.78 million, even though it's currently 1.79, and then the lower one will be got to get this right, 6 million. So from 1.68. So it's really counterintuitive, and you need to be, obviously, that the difference is not enormous, but it's enough for someone to fall foul of it. If they think, oh yeah, I've got my 3-year bring forward because I'm less than 1.68, I'm 1.675, I'm in, and then you're actually not, because of the way those thresholds work for the next financial year.
Yeah, and the point we were making earlier about you wanting to be strategic about contributions and the bring forward thing. The way that this all falls together is almost not encouraging, but it's almost facilitating the fact that it's easier to make errors, and maybe the errors are going to trigger things that, oh, you do realize that you've gone over, so now you've triggered the bring forward provisions, which is obviously not ideal. And you touched on something a little bit earlier, about how the rules surrounding contributions have changed. So in a previous life, it was whether or not the trustees could actually accept the contributions, and that would be the decider of whether or not there was an error or not. And of course, the ensuing penalties were excessive there as well. Now, obviously, it's not up to whether or not the trustees can accept it. I mean, really, in a normal set of circumstances, there wouldn't really be very much to say that they can't accept it.
Pretty much, yeah.
But then again, that produces on the back end of it a whole lot of, well, they're not a gatekeeper anymore. So the money just goes into super, and then you deal with it afterwards, or almost, if it's made in error. I don't know. I mean, is that a better solution? I mean, obviously the penalties are slightly better. You alluded to the really severe outcomes of the excess contribution penalties going back quite a while, and they're obviously a little bit more neutral now, or less severe, I should say now. But you know, is that a better way to do it? Because obviously, well, I would think on the surface, it's probably easier for trustees to make mistakes now.
Oh, absolutely. And I think that's where we are going to see more excess considerations coming through, because, yep, I've met the work test. Well, actually, you haven't. And so because the fund then can't reject that contribution on the basis that the work test hasn't been met, it's would be treated as a non-concessional contribution, and they'd end up with an excess, maybe they'd end up with a inadvertent triggering of a bring forward period. So it's definitely, I feel like we'll get more errors because of that coming through. However, to your point that you mentioned, it's not as prohibitive now as it used to be in terms of having an excess. So if you had an excess contribution back in the day, up to 95% tax. And so because you couldn't release or refund the contributions, but then those rules changed, and that was not the intention. The intention was that if you did go over your cap, you would receive a refund of it, but that wasn't how the law was drafted at the time. So there were amendments made, and that just made it, again, not as oppressive to go over your contribution cap. There's still a bit of, I call it, like I said, the faffing around factor of dealing with it, but it's not diabolical from that perspective. And the other occasions where because the contribution caps, that particularly the concessional ones, continued to drop, the people going over that cap became a bit more common, where they were high income earners or they had multiple jobs, and their employers had to satisfy their super guarantee obligations. And so they were going over their caps inadvertently there. Now you can opt out of super guarantee these days, but that's a process in itself, and you've got to have a lot of be very proactive in terms of putting that in place. I've seen situations where if the individual has a board position, but they're employed ultimately by a government entity, that whole change to the way they're paid needs to get signed off by the minister. So that's not going to happen. So they're like, look, we'll just deal with it from the other side of things. And with excess concessional contributions, there used to be a charge that applied to the difference between the 15% tax on the contribution and the person's marginal tax rate. So it wasn't too bad, but that actually was repealed back when we had the increase in the bring forward being available up to age 67. So that came through, and I mean, in my view, it wasn't a massive massively awful charge that applied, but that's a good outcome. So it's from that perspective. So at least it's really then a timing issue on you claim your tax deduction, or the tax deduction has been claimed, it gets added back, an excess concessional contribution. I guess we haven't even spoken about those yet. Excess concessional contribution automatically gets added back to your assessable income for the year, taxed at your marginal rate, but you get an offset for the fact that the super fund has paid tax on it. And that is the default position. So that's always how it works. But you can decide whether to release the excess from your super, and then that's where the tax gets deducted from. Or you can just leave it in there and go, oh, it was $10, who cares? But then if you leave it in there, the gross excess, so if I'm $10 over, that $10, that will count towards my non-concessional cap. So then you could inadvertently trigger that bring forward period. Now, in saying that, because we might be thinking, oh, $10, who cares? It doesn't really matter. And I've mentioned, it's $1 over that technically triggers a bring forward period. Now, with that excess concessional cap that then becomes a non-concessional contribution, many years ago, the tax office in one of their national tax liaison group meetings, so I'm talking some time ago, this was brought to their attention, and the whole excess concessional contribution that isn't released being treated as a non-concessional contribution. And then comments were made about there being a de minimis rule that would apply to that, the triggering of the bring forward, not that it's not a non-concessional contribution, but that it may not trigger a bring forward period. But there was never any actual indication of what the threshold was. Is $10 okay, but $100 you're two over, or $1,000 and you hit that. So for those who are listening and they encounter that, and it is a very small excess concessional contribution that is not released, that triggers a bring forward because it gets classified as a non-concessional contribution, there may be an avenue to sort of put your hand up and go to the tax office and say, look, under this de minimis guidance that you had provided, is that an opportunity to have that not trigger the bring forward? So it doesn't stop it from being a non-concessional contribution, but it just doesn't trigger the bring forward. So again, there's a lot of things there to consider from that perspective.
Well, you'd have to think that a practical application like that would make a lot of sense.
Yep.
We argue all the time that penalties, whatever it might relate to, sometimes can be too excessive. I mean, the analogy of cracking a walnut with a sledgehammer is often used. And you would just think that, well, yeah, I know technically speaking, if you go over, you are supposed to trigger the bring forward rules. But I mean, seriously, if it's not the intention, and look, let's be perfectly honest, maybe not up to $1,000, but I think if we set up to $100 or even $500, there would be a case in point to argue that I'm pretty sure that person didn't do it deliberately. The amount that they went over would be
Oh, it's minor.
Immaterial, where you would think that person's trying to exploit the rules, if you know what I mean. I mean, it just wouldn't. It's like if somebody committed fraud for $1, you wouldn't even consider that fraud, would you? Or that person would be the dumbest criminal in the whole world, because for the gain they're getting. But like, what's the point? I mean,
the mischief there's just
exactly.
That's exactly right.
You would think that would be a sensible way to go, and I don't know whether or not the tax office has formalized whether or not you can do this, but I do say that in a lot of cases, with certainly self-managed super, they are reasonable in their approach. So even though it may not be a formal channel, it was obviously raised in that group a number of years ago, but maybe nothing set in stone was actually implemented. I think their approach is pretty good. Their approach is pretty positive, and their approach is pretty helpful. So, Yes, it's always worth having that conversation. I would imagine, because I mean, seriously, you don't want to go down a path that you didn't intend to go down in the first place. And again, that might actually restrict you with, oh, I can't do what I wanted to do with my contributions now, or I have to wait for the 2-year or the 3-year period to expire just because I made that stupid mistake. And it's put a bit of a dent in what my strategy was going to be.
Yeah, exactly. And I think that that's really what the issue is. And it's interesting. I recall there were some matters that went through the courts before they changed the way that the refunding worked. And one of the comments from one of the judges, I think it was Justice McKerricker, actually made a comment saying, "Look, this tax is very, it's very penalising, but that's what the law says. So I can only interpret the law. That's what my role is, and that's what the law says. So if you go over so back then, if you went over your concessional cap, it counted as a non-concessional contribution. And then if you went over your non-concessional cap, then so that's where your 95% tax rate arose. So there was no refunding to perhaps manage the position. And, that whole inadvertent like going over your cap with an excess concessional contribution counting towards your non-concessional cap because you don't release a refund, I basically will say to people almost from a blanket perspective, when there's an excess concessional contribution, release it from super, because even if it's only minor, you just don't want to then have to go through. There could be like you do it that one time and then you don't have a potential excess non-concessional contribution, which becomes even more of a pain in the backside to deal with, plus a nastier tax outcome because of that associated earnings. Just deal with that at the concessional contribution element, release it from super. It's generally quite, straightforward these days for that to happen, and from the taxpayer's perspective, and then play on rather than like coming up with, you may end up with a situation where you get an excess notice subsequently of a non-concessional contribution. So it's just that has that compounding flow-on effect. So it certainly is worthwhile just as a blanket. Okay, yep, I've got an excess concessional, receive the refund, even if it's a very minor amount, which I know it's immaterial, and the actual work required to go down that release path just seems ridiculous for a very minor amount. But because it could have such wider implications, it's not worth sort of not doing it, if that makes sense.
Well, I think you've hit the nail on the head, Jemma. I mean, we discuss how complicated some of these rules are, and subsequently how complicated it might be to change strategy and to deal with what you're being faced with, especially if you've made an error. What could be better than taking the simplest path? Just as you say, to reset and move on.
Yeah.
Because you're going to have to remember, oh, what did I do there, and where am I at right now with this? Oh, what can I do now? Oh, this is really hard. Whereas if you just wipe the slate clean pretty much of your error and just move on from there, surely that's a better way to go. I would have thought anyway.
Well, that's what my view is. And also, by the time these notices come through, it can be, so let's say you lodge your return in May for a particular year. So that's nearly 2 years after the start of the year that you've lodged. So by then you're thinking, what happened? I went over by what, $20? It's what? Just, again, wipe the slate clean, because it's mainly just the compounding effect, and then the issue with then not being able to implement perhaps some strategies that you've spent money to get the advice on, because some small thing ends up triggering inadvertently what that looks like. And I guess that's the other consideration with all of these is being really careful when you do trigger bring forward periods. So we don't want to inadvertently do it, but likewise, the comment I made earlier about, well, maybe you do 110 this year to do 360 next year. But the other thing that we sometimes encounter from that perspective is, so maybe I do 110 this year, but then I also use my downsizer if I'm eligible to do that. So this year I might be putting in, what's that, 410,000. But then if that then has that'll add to my total super balance. So at 30 June 24, I might not then be able to do my 360 because I've done my downsizer this year rather than, managing how that position works. So it's looking at, what is the opportunity in the current year? And do you do 110 to do three and then do 360 next year? Is it this is the last time I might have to do my 330 if I'm also going to put in a $300,000 downsizer, or I'm also going to use the retirement exemption and put in my $500,000 cap, or I'm eligible to put in my higher $1.7 odd million CGT cap. So again, I won't be able to do a 330 or a 360 next year. I have to do all those contributions this year. So it's again managing that sort of position, looking at that. The other thing is that so with the bring forward period, or you looking at, okay, well, what's my contribution cap for the 23-24 year? So I'm looking at what my total super balance was last year. If I'm under 1.68 million, then I might have $330,000 available as my contribution limit. But the other thing that determines that is also what my contribution history is. So at 30 June 2023, I've got 1.68. So you think just looking at those elements, I've got 300, and I'm under 75, $330,000 available. But hang on, last year I put in 220, or the year before that I put in 330, or the year before that I put in an amount. So it's worthwhile looking at, okay, well, what's my position this year? What might I have available? But hang on, what did I do the year before? What did I do the year before? And in my view, going back even further, because what can happen is, say in the historically, I put in $180,000 and I triggered a bring forward period back then. So then 2 years later, I put in 120. And if that was, say, last financial year, I might look at that and go, I put in 120 last year. So I triggered a bring forward. So this year I've only got XYZ left of what my bring forward might be. So I can only put in 210. But actually the 120 was serving out a previous bring forward. So it actually reset. So I would encourage people, if they're looking at that history, to go back, a couple of extra years just to see how that works. And back to my comment earlier about, so let's say I put in 180 several years ago. Okay, well, I triggered the bring forward then. So that would have applied for, that year and the next 2 years. So my 120 was serving out that period. But if I did my 180 where my total super balance was between where my limit was then only a 2-year bring forward, then actually the 120 did trigger a bring forward in the current for that last year and the current two. So and the next two. So I think we again need to just double check and look back historically to get that information. Generally, you can get that off the tax portal for the individual, or they can get that total super balance and contribution history off their MyGov, but it's only as good as the information that was pumped into it. So if their super fund is not up to date, then that information might not be in there. So it's worthwhile using it as, it might be 90% accurate, but to then still double check if you're advising clients on that sort of thing. But the other thing that is really good about that is that those superannuation only insurance policies, that will be captured in that report that's there. And I know this is an area of contentiousness for the financial advising industry, is that they don't have access to the tax portal because they're not the tax agent. But that's where it's at least the MyGov of the individual, if they have MyGov, does provide that information. And the same sort of falls true for the accountants out there or the administrators that don't look after the individual. So you can only get access to that information if you're the individual's tax agent. So again, that MyGov side of things is that's where it's captured. But like I said, it's garbage in, garbage out. So double checking that history yourself. And I know that sounds like a lot of painful work to do, but you want to get it right, because if you don't get it right, then you can have excess non-concessional contributions, the associated earnings tax on that all coming through. And then, like I said, the faffing around factor comes through, and that requires work. So at that point in time, does the tax agent, they have to lodge the election, then you've got to deal with the excess release through SuperStream. So, all of those sorts of things flowing through as well. If you can mitigate it up front, that's always the better. If that can't be achieved and it's inadvertent, it is at least not the end of the world.
I just think that's brilliant. The powers that be set up portals that allow you to access information which will be useful to you, and then limit who can access it, to make it that much more difficult for you to maybe get counsel or advice on what to do and where you're at in a situation. To me, that just makes absolutely no sense. And that's probably a topic for another day. I know the argument has been going on for a long period of time. I'm just quite staggered that no one's stepped up to the plate to say that, oh yeah, this is a bit of an issue. Why don't we just address it now? It's not.
I think
I mean,
that
that's a
they are
pretty
trying
easy
to.
one to fix.
Oh, I think, again, it's an issue for another another chat. I think that they're trying to look at the best ways to manage it, so that then maybe the financial advisor has view only access, but then how do you run that through, like I don't know, like the systems that the tax office has, like again the authorization, privacy issues, tax file numbers are massive privacy consideration. So what does that look like? I take consolation in the fact that a lot of the information that I'm talking about here that would be you'd need to look at from a strategic perspective is available through MyGov, and the tax office sort of portal through there, and that can be really helpful, provided the person has MyGov and they've been able to connect it up. So it's actually connecting up your tax office history with your MyGov can be a challenge even in itself, getting all the right IDs and documentation. Anyway, we have digressed somewhat.
Yeah, but that certainly is a bugbear, and as I said, it's been discussed for forever and a day, it seems, so far. So getting some action there would be really good. Jemma, I think you mentioned something that's really important too. When you introduce downsizer into the discussion, really people have to look at the way everything fits together in the whole contribution puzzle, if I could describe it as that, whereby you just about can't look at anything in isolation, can you?
Oh,
All the
definitely
pieces
not.
fit together,
They do.
and
Yep.
whichever one that you go towards, it will have implications for other things that you potentially want to do as well. It's
Yep,
amazing.
absolutely. And I think that downsizer, it's 300,000. That's, that could push someone over the thresholds. That could be a good opportunity for someone who doesn't have very much super, if they're, because it's 55's the threshold now. So it's actually available a lot younger, when it started at 65. So if someone who hasn't built up much super, they use that downsizer. But then does that push them over? We've been talking about non-concessional contribution caps, but there's also the total super balance. So total super balance, non-concessional caps, there's also the total super balance for the carry forward concessional contributions, which we haven't even spoken about yet. And that's a massive opportunity for people to top up there where they've got the taxable income for it. And so if you put in your downsizer, and that pushes you over that $500,000 threshold, then you lose the ability to do your top ups there. So, that you need to consider what that looks like. So there's, it is a jigsaw, and there's lots of jigsaw pieces that need to be fit in. Otherwise, it doesn't look like a pretty balloon or whatever it might be. So you do need to make sure that all of those factors are taken into consideration, and then you overlay like the tax officer's ruling on if you've made an expense on behalf of the fund and haven't sought reimbursement, that is classified as a contribution. If you forgive a debt, so there's a limited recourse borrowing arrangement and there's some debt forgiveness there, that's classified as a contribution. So there's all these other bits and pieces that come through. Someone's made off-market share transfer, but because it hasn't gone through the bank account until the financials get looked at, you might not know. And it could have just been through the share registry rather than through the advisor's holder identification number. So again, that gets missed until a search is done to show, all the holding statements. So there's a lot of things there that need to be looked at from that perspective.
Earlier, we spoke about wanting to be strategic about these things, but the way the rules are going and the way some of the rules have changed, i.e., the trustee is no longer the gatekeeper for being able to accept contributions. At the coalface, are you seeing more errors being made as far as this sort of thing goes? Because it's almost like the way that the rules have headed, and I mentioned this before, it's almost easier to make inadvertent errors, which obviously you don't want to, and then that takes you down a whole nother rabbit hole of how do I fix it? Do you see a lot of people making these errors simply because it's so easy to make mistakes?
Not yet, because that change has only been in place since 1 July 22. So I actually, 22, 23 financials are happening sort of now, tax returns and things like that. And I think as the uptake of the fact that you can make contributions up to 75 sort of ticks through, I think that there'll be more that will become more prevalent. Hopefully not, but I think that you're right. There's an opportunity for more error there because of that, the removal of that from that gatekeeper sort of role that came in there. But not quite yet, but it was, I would expect, like to your point, that it will come through. Yep.
Well, Jemma, we're pretty much on limit now. I know that there were other things that we were going to discuss, but we'll leave them for another day because there's so many issues to discuss as far as this goes. But I think we did a pretty good job, or you did a pretty good job in having a bit of a deep dive into the bring forward provisions and how complicated it really is and how many factors contribute to how much you can do when it's triggered, that sort of thing. Yeah, I don't understand how anybody could try and sort any of this out without getting advice personally.
Well, it's and I think that some of the items there are a bit misunderstood, more widely. So if the industry and advisors, if it's confusing for the industry, then how is a regular taxpayer ever going to get their heads around some of these things? And we haven't even spoken about the carry forward concessional caps and all those, like the deduction notices. So that'll be a topic for another session, I think, talking about concessional bits and pieces and opportunities. And just to, I don't know, preempt that, this is the first year where you can do the full whack of carry forward concessional. So, it applies. So you look at your current year's cap, which is 27.5, and the previous 5. So if you haven't made any concessional contributions in the current year and the previous 5, you've got $157,500 that you can contribute and claim a tax deduction for if your total super balance is less than $500,000 at 30 June 23. So that's a substantial opportunity for some people to look at. And I'm not saying they have to use the whole thing, but there could be an avenue there from that perspective, from a tax planning perspective for people in the lead up to 30 June. But anyway, that's another hour's worth of chatting just on that front. This sort of thing. I enjoy our chats, Darin, because I like to talk about all things superannuation. So once again, thank you very much for having me on the podcast today.
Well, I love these chats simply because whenever we talk about these things, we uncover so many other subjects that we need to cover for us in subsequent podcasts, which is great. It's almost like a self-fulfilling thing that we just keep rolling with. Oh,
Exactly.
here's a tangential issue, but we'll discuss that another day, which is fantastic. It's a
Yeah.
never-ending thing. So look, thanks again for your time today, Jemma. Thank you for everybody's company out there. We hope you enjoy listening to these talking points as much as we enjoy bringing them to you. So thanks again for your company. Thanks, Jemma, all the way from Perth. And we hope you enjoyed the Cross Country podcast, and we hope that you'll join us again the next time we put one of these together. Thanks very
Thanks
much,
for having
everyone.
me.